The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast. Okay. Hi, Gareth. It's Thursday, the 17th of April. Welcome back for another week of what's been going on in the world of financial markets. What has been happening this week for you?
Well, yeah, it's felt a little bit calmer, which is no bad thing after a few tumultuous weeks. Just kicking off with a couple of bits of news from the progressive client base. But before we get to those, there's also some quite good news in slightly broader terms. We've got an IPO on the horizon.
Oh, yeah, I saw that. Yeah.
MHA, the UK arm of Baker Tilly, I think, looking to IPO over the next few weeks, raising a decent amount of capital. And by all accounts, it's being relatively well received. So it's great to see the UK's IPO market moving towards reopening. And if that's a harbinger of more activity across the rest of the year, that would be a great thing to see. So nice to see that deal hopefully being done. And it'll be good to see how it performs in the aftermarket. But great to see a little bit of some signs of life there. We also had signs of life from the progressive client base, and a couple of the smaller stocks reported news. And in both cases, it was quite well received. So we had TinyBuild, which is a developer of low-cost games for sort of PCs and various other platforms. On Tuesday, they had their full-year results to December. The results themselves are pretty much in line with expectations, but they were talking relatively positively about the prospects, the pipeline of gains they've got coming through. And I think it's a business that's really cut its costs. It's been a very tough market over the last 2 or 3 years. They've changed the model to focus more on their own intellectual property. They're really starting to see the benefit of that. And the shares reacted well. They were up 20% at one point. They've drifted back since, but at least those results were well received. And I think the market was receptive to a decent outlook and prognosis from TinyBuild. And then the following day, we had Gear for Music, which is an online retailer of musical instruments and other equipment. They had two bits of news, really. First of all, they were talking about trading, which they're describing double-digit sales growth across the back end of March and early April. So some good, strong revenue performance. But I think probably more importantly, they're starting to benefit from their competitors struggling. And they previously mentioned that there was a big price war going on in their industry. And now actually two of the competition, relatively large competing businesses, one in the UK and one, I think, in Benelux, have fallen into insolvency proceedings. And in one case, Gear for Music's been able to acquire some quite low-cost stock from the UK administrator of one of those businesses. So an interesting sort of combination of Gear for Music, they've cut their costs, changed their model and adapted, and they're now starting to benefit from the fact that they're almost last man standing, that they're doing well in a market where other people are not performing well. And investors were delighted to see that. The stock was also up 20%, and interesting to see how that business can evolve into the future. But overall, a good set of announcements from Gear for Music. So I think in both cases, you've had stocks they've been under pressure for a long time. They've changed their model. They've cut their costs. They've done all the right things to adapt. And the market's now responding actually pretty well to news of things just not getting worse. So it's quite pleasing to see.
Yeah, I thought that's interesting. The Gear for Music situation in particular, that's a business that has been buffeted by particularly the initial benefit and then challenges of the lockdown and COVID.
Yeah.
Prior to that, moving from being a domestic retailer to being a pan-European retailer with Brexit. So if you look at the share price of something like Gear for Music, it's been incredibly volatile over the last 10 years or so as it's been building its presence in its niche market. And I thought the update it provided this week was really interesting in that it showed that it had built resilience into its business and adapted to a very significantly changing trading environment. And if one could extrapolate that into the wider UK corporate scene as an ecosystem that has had to deal with these challenges, if there's one thing that is certain is that we are moving into a more uncertain global trading environment.
That's for sure.
There's a certain person in the White House who's making sure that that is the case. The UK corporates must be relatively better attuned and able to say, well, we've seen some of these things before. We've already had to make an adaptation to treating Europe as a separate market to the UK in the case of someone like Gear for Music. And what do you know? They've done what they said they were going to do, and the shares get significantly re-rated with the prospect of it being significantly further re-rated and not look expensive in a global context. If the UK can rise to these challenges or not sink as low as other people are sinking as a result of these challenges, the scope for re-rating in the UK, I think, is significant. So, yeah, I think that's a really insightful test case of the type of market that we're going into, because it is definitely highly uncertain and unpredictable out there, isn't it?
Yeah, absolutely is. And you're right, GIF Music, it's a very small sort of microcosm of that reality, but absolutely that they've had to adapt to huge change, but they've done it well. They're doing okay, and the market's rewarding that pretty handsomely in terms of recent share price performance. And yes, if that's relevant to the wider UK, and we've been through COVID the same as most of the rest of the world had that disruption to deal with, but we've also had Brexit. And yes, if UK PLC has adapted well to Brexit and managed through that process, then you would have to believe that we're going to manage better a changing or confusing landscape in terms of coming and going on tariffs and trade barriers of all sorts. As a nation, we're probably better placed to deal with that than many others. So absolutely right. And yeah, given that the valuations as they are, you'd hope that if capital is flowing out of the US to other places, for both reasons, valuation and our increased resilience or better ability to deal with change, we would be an attractive place for that global capital flow. So yeah, we'll see how that plays out over the coming quarters. So what's been going on in that more tumultuous macro landscape that we should be thinking about this week? What's been going on the broader stage?
Well, Trump's keeping everybody on his toes, isn't he? And while in some ways I felt this week maybe the pace of things has slowed down a bit and the market is sort of normalizing to the sort of Trump-induced chaos. But just to sort of zoom out a bit and sort of try and take stock, I think last time we said that the sort of market indicators that we should keep an eye on were the US 10-year Treasury yield, the value of the dollar, the DXY, and the gold price. And over the last week, while I might think things have sort of normalized and quietened down a bit, if you just look at what those indicators have done, the dollar is down by 3%, the 10-year Treasury yield fall by 20 basis points from the panicky highs of last week, and gold strengthened further by an extraordinary 6%. So by any measure, that is highly variant week of changes of these key macro financial indicators.
Big changes in some very important numbers. Yeah, absolutely.
And I guess in one level, it's not really surprising because markets are trying to adjust to tariff news, which they've been hit with, but the news itself is a moving target. And the market on top of that has to then worry about the second order consequences, if you like, of this volatility, which is the emergence of dysfunction in things like the bond market, which we saw last week, and sort of decoupling of currencies, which is an ever-present threat. So we've got this sort of emergent risk of a type of global Liz Truss moment, if you like.
Yeah, as financial institutions can't cope with those sudden and often unexpected changes in those big numbers. That's the issue, is that will start to cause strain in financial markets themselves.
Yes, and I think that was the main characteristic of the bond market last week when we saw this blowout in yields, particularly the key 10-year Treasury yield, which, okay, it's ameliorated this week, I think, by some swift action on the part of Scott Bessent to calm things down. But the more he spoke about the means by which he's going to get the world to buy his bonds, I think the more he revealed about the underlying nature of his problem. So I think while he has fixed his short-term problem, he's sort of opening up the world's gaze to the underlying issue that he's got in terms of basically refinancing $9 trillion worth of federal debt in the next 12 months. And the clock is ticking and the bond market is not really bending to his way of the world. That is a problem.
Yeah, you can't force people to buy these bonds. It sounds like he's almost going to try, but it's not really a long-term plan, I don't think.
Well, he has appointed himself America's biggest bond salesman, and he's been doing what he can to return calm to the market that's confronting him. And his explanation, and he's at least partly right, that the blowout in yields was caused by short-term deleveraging, and he said it wasn't systematic, fundamental sovereign wealth fund selling. And I think that's probably broadly true. We are a world that is suddenly having to delever the billions of dollars that we direct to try and eke out this basis trade opportunity that exists along the yield curve of the world's largest bond market. These are the types of trade that Warren Buffett has called trying to pick up quarters on the motorway. It relies on historic correlation in markets that allow small amounts of return to be eked by selling futures and buying spot. And to make these into a meaningful return, you borrow lots of money to do it in size. And it rests on the assumption that certain markets correlate with each other, which in normal conditions they do. But in abnormal conditions, when markets move violently, these correlations get knocked out of kilter. And therefore, you see a dash for cash or a deleveraging, which piles huge pressure on what had previously been thought as safe and liquid markets. They become one directional. I mean, Scott Bessent was largely correct in his short-term analysis this week, and the bond vigilantes have stepped back. But the longer-term question remains for not just Scott Bessent, but the whole world. Every central bank is asking themselves, who is going to buy the bonds? Helpfully, Bessent talked about this on TV this week. And he said that part of the deregulation that's coming in the banking industry will be changing what's called the supplementary leverage ratio, which will allow banks to buy more treasuries without a big capital charge. So I would expect that we will have created a new buyer for treasury securities, a larger, more durable buyer, rather than a few hedge funds based in London, New York, and wherever else.
So he's magicked up some long-term new holders of US government bonds.
Well, he is saying this will happen, and it's an ongoing debate between him and the US regulators to loosen the balance sheet restrictions on US banks through this SLR mechanism to provide a reliable funding partner for the US Treasury to own these what are known as regulated risk-free assets. And as I said, I think he's right that these would, once created or once expanded, will become more dependable buyers of his bonds than the short-term traders among the hedge funds. But you have to be careful what you wish for, because we're just 2 years on from a thing called the regional banking crisis, which saw the disappearance of a number of quite well-established US banks. And as David Dredge pointed out in his analysis of sort of sharp world problems and the work of what he terms rational accounting man, he says banks don't go out of business by taking excessive risk. Banks go out of business by leveraging that which they can account for as risk less. So this is an example of what I've heard some people describe as yield curve distortion, which is manipulating the market by creating artificial buyers who can launder volatility. Ultimately, we're being forced to buy them because the customers of the balance sheets that are being expanded to take on this risk are US bank customers. They won't pay the price when it goes wrong. The taxpayer will pay.
Yeah, it feels scarily circular, to be honest. And if you're saying the risk in these bond assets is going to go down because we've got these new buyers, and you're creating the new buyers by saying these are effectively riskless or almost riskless assets, so you shouldn't have to pledge capital against borrowing to buy them, you're building on confidence more than anything else. And if that holds, then that's great. But it does feel like it could all come tumbling down if they suddenly prove themselves to be not riskless assets, fall in value, you've borrowed against them, and then we've got a 2007, 2008 problem.
Well, you've certainly got a banking crisis, but ultimately the way to fix this problem is to crash the economy now or conduct a slow burn over the next several decades and hope people don't work out what's going on. That is the process of managing inflation such that we reduce the real cost of repaying the underlying debt in a currency that ultimately is devalued versus whatever value we think that currency has today. That is the process of inflating away the debt.
Yes.
Overnight, we had comments from a speech that Jay Powell made to the Economic Club of New York that this tariff tantrum that we're going through and whatever comes from it will create lower levels of economic growth and higher levels of long-run inflation than otherwise would have been the case. Sure, we might get lower inflation or even deflation in a world taken into recession, but the realignment of the global economy along MAGA lines and the return of these mercantile trade policies and the evolution of national capitalism, as Russell Napier calls it, creates a thing called stagflation. And we last saw that in any consistent, meaningful way in the 1970s.
Yeah.
And if that is the analogy, then what we've seen in the gold price, for example, is just a starter. Because in the decade of the 1970s, the gold price went from $35 an ounce to $800 an ounce, which I think is a 50-fold return. So that is why a 6% move in the gold price this week, which I think is one of the few safety valves investors have to protect themselves from this sharp world of central banking, is so significant. And it could be a pointer to a much bigger change in the coming period.
So lots to keep an eye on there. And how about close to home? How about the UK? Are we still this hoped for as a bastion of stability, and our ability to navigate these choppy waters is better than other people around us? Do you think we're starting to see the benefit of any of that, or have markets not yet really woken up to that exciting opportunity?
Well, like everywhere else, we're seeing long-term bond yields moving out. We're getting, as Simon French at Panmure Liberum pointed out this week, we're getting very divergent views of inflation as measured by consumer surveys and as measured by participants in our gilt market. And they're pointing in strongly divergent directions, with the gilt market pointing to lower inflation and consumer expectations starting to embed higher expectations of inflation. What Simon argues is that the gilt market view will win out. In the second half of this year, we will see multiple interest rate cuts. And if that can be combined with UK employment data that we saw this week, which was relatively benign, and average earnings data still showing strong real wage growth, and a world where the dollar is weakening, so the strength of sterling remains relatively high, we could get a bit of a Goldilocks moment for the UK consumer and the companies serving the UK consumer, particularly if we can have our cake and eat it and benefit, as we've spoken about before, by being dumped upon by, for example, cheap Chinese manufactured goods, and get the deflationary benefit of that process while also doing a bilateral trade deal with the US. Now, you can see a scenario later this year where it actually works quite well for the UK economy. That's, of course, before you sort of factor in the idea that, according to the IFS, Rachel Reeves should raise the basic level of income tax, which is something we haven't seen for 50 years. But with all these changes going on, I think to come back to this idea of a changing world order and rotating of the world's capital away from its overdependence on the US, the UK, almost by definition, has to become a beneficiary.
Okay, that all sounds at least moderately optimistic. If there's a way through that which can deliver all of those things, that would be fantastic to see. So yeah, let's keep an eye on it. And in the shorter term, what have we got over the next 7 days to look forward to try and keep us fixed on that medium-term opportunity?
Yeah, the likelihood for bilateral trade deals are going to be the big hope. I don't think it's a surprise that Japan is first up to get the treatment to try and get a deal. And as Bloomberg said today, if Japan can't get a deal, there's no hope for the rest of us.
Right. Okay.
But I think the UK will be in the first cohort of countries that will be in for their trade deal negotiations. And I keep coming back to this carrot and stick analogy in this whole process, where the carrot that is being adopted here is that they might stop using the stick. But I think we have got some hope that in our case, we won't get quite such a big stick as some other trading partners to the US. But nearer term this week, tomorrow, we get, I think, what could be quite significant Japanese inflation data. And we know the Japanese inflation rate, which is running consistently above 3.5% and is expected to come in somewhere around 3.7% for last month. The problem of inflation in Japan is not that it's just creeping higher. It is now suffering from some of the highest reported inflation rate anywhere in the world. So Japan just seems to be screaming at the moment to me that this is something the world needs to wake up to and deal with. And I think Scott Besant is on the job. Next week, we get UK PMI data, and I think it'd be interesting to see how quickly this survey data picks up tariff worries. We get UK retail sales data for March, which is expected to be heading down. See whether the UK economy can continue to defy the gloom that seems to be baked in most places. We also get US durable goods orders for March next Thursday, which is expected to show a decline from February's figure. And of course, amidst all this, both in the UK and I think probably more pertinently in the US, we're in the middle of Q1 reporting. And I think it's interesting the number of companies who are guiding lower or just withdrawing guidance in the face of this. I'd like to say unprecedented, but I think, I suppose it said we're in an unprecedented moment of the overuse of the word unprecedented. But but this period of heightened uncertainty that we're going through at the moment.
Yeah, if people start to use the tariff situation a little bit like COVID, a lot of companies are withdrawing guidance and refusing to be drawn on the way they thought they'd perform. And it does start to feel that way with tariffs being so large and so changeable. Yeah, I wouldn't be surprised to see more companies doing that and withdrawing guidance or just only lowballing numbers. So interested to see what happens across that reporting season. Good stuff. Okay, Jeremy, thank you very much. As always, fantastic insight. Hope you have a great Easter weekend. Wish all our listeners the same. We'll catch up this time next week.
Okay.
Talk to you then.
Look forward to it.
Brought to you by Progressive Equity.